Thanks, Jeanette. Can first off, can everybody hear me okay? Jeanette, I know you could. Could everybody out there hear me okay? All right, looks good. Beautiful. Beautiful. Well, I am coming to you from Chicago. Um, I'm Scott Bauer, as you can see on the screen here, CEO of Prosper Trading Academy. I was a real trader on the floor, guys. I started my career back in 1990 on the floor of the Chicago Board Options Exchange, traded on the floor for more time than you guys would ever like to hear. Went through the ringer, okay, learning this business from the ground up. I have perfected, I am your go-to guy to learn how to trade options volatility. All right. Before we go any further, though, you have to knock out a couple things here, which we know we all have to do. All right. So here's the legalese stuff. We got to go over that fine print our legal team makes us put out there. All the disclaimers basically just says that success in trading is not guaranteed, and I think you probably all know that. And quite frankly, if you're looking for that 100% guaranteed magic pill that promises you're never going to lose on a trade again, just hop off right now and go about your Saturday, because that ain't happening. It is not happening. However, this presentation is for those of you looking for real ways to protect your trades while maximizing profit potential. Okay, that's what I do. Okay, what I'm about to show you is proven, effective, and there is no such thing as perfect, guys. Right? I'm going to show you trade examples later that worked, and I'm going to show you trade examples from this week that didn't work as well. All right. If anybody tells you otherwise, just avoid those snake oil salesmen, honestly. All right, let's get back to the good stuff here. Again, thanks so much for joining me this morning here. Appreciate your time on a Saturday here. I'm the CEO of Prosper Trading Academy. All right. Fun fact about me. Fun fact about me. I was the very first, not only the very first, but the only market maker in the world to be trading Amazon.com options. Okay, back in the late 1990s when those options were listed at the Chicago Board Options Exchange. Okay, I'm going to tell you about that in a second. I'm actually so pumped up to share my knowledge with you that can kickstart your trading success. So stick with me for the next hour, 55 minutes, whatever it is now, and I'm going to make you a promise, okay, that by the time you leave today, you're going to have the confidence to use volatility for massive market potential. Not be afraid of it, but embrace it. I'm going to show you proven strategies to find double and triple digit profit opportunities, regardless of market conditions. And God knows that the market we're in right now, we could be up 500, down 500 one day or the next. People are fearful of that. Volatility is something to embrace. And I'm going to give you a step-by-step plan to start pulling returns. Well, not tomorrow, but on Monday. Okay, literally on Monday. Okay, I promise that when this webinar is done, you're not going to look at trading the same way again. All right, I'm going to show you how to leverage that volatility to your advantage. Okay, so Jeanette was talking a little bit about me, about what I do. She was with me in New York on that day that I literally had 4 or 5 live TV interviews at Fox Business and CNBC and Bloomberg, Yahoo Finance, literally all in a row, and I'm running around with laptop in hand. This is just a snapshot of that here, guys. And this is just a little bit of my pedigree here. Okay, so I started on the CBOE floor in 1991. Built up a very successful trading firm with over 200 traders called BOTA, B-O-T-T-A Capital Management. Went on to become a vice president and trade and run the S&P 500 options pit for Goldman Sachs at the CBOE. All right. And then again, like I said, I was the first and only market maker for Amazon.com. Now, if I were you guys, I'd be saying, you're full of what? How could you have been the only market maker for Amazon.com? Does anybody know how options used to work back, before the advent of multiple listings? So basically up until about the year 2000 or the early 2000s. I don't know if you knew this or not, but options, okay, were only listed on a specific exchange. So options like Amazon, Coca-Cola, IBM, those were only listed at the CBOE. in Chicago. They weren't in New York. They weren't in San Francisco. They weren't in Philadelphia. Vice versa. There were some stocks like Microsoft was a big one that was only listed in New York. We couldn't trade that in Chicago. So when Amazon options first were listed in the late 90s, I literally was the only market maker for about 3 months on the CBOE, which meant in the world, because they weren't multiply listed, to trade Amazon.com options. Honestly, that's where I really got my start and really honed my expertise to learn how to trade and master volatility. All right. All right. Enough about me here. Okay. Let's get going here. All right. Again, just so you know, I'm Scott Bauer, CEO of Prosper Trading Academy. You can see me every single day on the major financial news networks, Fox Business, CNBC, TD Ameritrade Network, Bloomberg, every single day. I've traded at the CBOE, I've traded at the CME. Our offices, like I said, I'm in Chicago. My office is 19 floors above the trading floor at the Chicago Board of Trade. Trading floor is on the 4th floor. Our office is on the 23rd floor. Okay, it's also one of the reasons why I'm a go-to guy for a lot of the networks, because they know if they ping me, I can literally be down on the trading floor. If I miss one elevator, I can be down there in about 2.5 minutes. All right, so I have learned this business from the ground up. Okay, I was brought into this business by my mentor, a buddy of mine, a little bit older than me, from a great baseball story that said, I want to teach you how to trade, and I didn't want to, and yada, yada, yada. And so I was brought into this business not knowing the first thing about options. Okay, and I literally learned this from the ground up. I traded against, just so you know, guys, I literally traded against Warren Buffett. You're going to say, again, Scott, you're full of you know what. Nope, not true. When I traded in the Coca-Cola pit, which was for about 6 or 7 years, okay, every single year in January, Warren Buffett would send an order in through Goldman Sachs to buy, you have no idea how many puts, 50,000, 100,000 puts, typically 15, 20% below the market. I don't mind selling them to him. I sold Warren Buffett thousands upon thousands of puts. You know why I didn't care? I was able to hedge that from a volatility standpoint and make money. Why was Warren Buffett buying all those puts? Well, as you know, how many millions upon millions of shares of Coca-Cola did he own, right? All he was doing was locking in his long shares of stock. Okay, so I would trade with him every year. He would use that as a hedge, and quite frankly, I would make a lot of money trading those puts against Warren Buffett. All right, thousands and thousands and thousands of them. Okay, again, I learned literally trading in the pits. Most people don't get that opportunity, and that's why you probably never get to see some of these strategies that I'm about to share with you. Okay, that's not on you. That's just the way the trading industry works. Big, fancy, advanced strategies that, most of these come from big institutions and trading floors and guys spending millions and millions of dollars on algorithms and testing strategies. And I learned them the hard way up. Okay, and it really boils down to one key secret sauce description: volatility. My go-to volatility strategies: calendar spreads and diagonal spreads. Now, many of you, and let me see a hand here. How many of you only like to trade credit spreads, where you like to collect money? I know a lot of people, you just want to collect money, right? Lots of you. I see that, lots of you. Okay, and 80% of trades, okay? And how many of you like to, okay, Haley, I like your answer. You said I prefer to be versatile. That's the way I trade. Volatility really directs me to the type of trade I make. If volatility is expensive and I get to collect a lot of premium, heck yeah, I'm going to sell it. I'm going to sell it when the odds are in my favor. And when volatility gets cheap and premium gets cheaper, I'm going to buy it, right? Because volatility is something known, and I don't want to get too technical here, guys, is known as mean reverting. Have you guys ever heard that terminology, mean reverting mathematics. What that means, no pun intended there, what that means is that volatility will always come back to its midpoint. When it gets really expensive, it comes back down. When it gets really cheap, it goes back up. Now, the secret sauce to that is we don't know the exact timing of that, but you have to know when to strike. You have to know the opportunity is there to both buy and sell. You have to, okay? Because that's how you maximize your trading abilities, okay? So this is just in the last week, guys. These are not examples from a year, 3 years ago. And I'm going to show you examples that we've literally done this week with the students in our class, live with our students. And just so you know, the students in my class that we give trading strategies and trading signals to, myself, the other traders, the other coaches that work with me, I'm trading these exact same strategies along with our students. So it's not that I'm just saying, hey, do this, do this, do this, and if it works out, great. If it doesn't, my money is behind every piece of advice, every single strategy that we give. I'm winning and I'm losing the same as our students. If it wasn't that way, how could you trust me? How could you trust Prosper if we weren't putting our money where our mouth is? Okay, so just over the last week where we've seen the Dow Jones literally trade in about, what, 1,500 point range. This says 1,000 point drop one day, but S&Ps have traded in a, back and forth, probably 100 point range. These are just two of the examples, two trades that we made, 127% in NXPI, 74% in ULTA, okay? Volatility is opportunity, folks. Don't be scared. Embrace it. All right, here we go. So one of my go-tos, and I like to keep this simple, right? There's that old adage, KISS, keep it simple, stupid, right? Options are simple. They're very confusing to some people, but when you break them down, when you break option strategies down, they really become quite basic, okay? There are thousands and thousands of different ways that you can come up with a trade, with a strategy. Keep it simple, folks. Don't try and overthink the situation. Don't overthink it. Okay, check this out. Check this out. Here is my example of a calendar diagonal spread. Who knows what the diagonal is? Okay, who knows what a diagonal spread is? Whether it's a call spread or put spread is irrelevant, but who knows what a diagonal spread is? It's a fairly simple strategy. However, knowing when to use it and how to take the most advantage of that strategy is the key. Okay, a couple of you have answered here. All right. So what this is basically a calendar spread. A calendar spread is a time spread where you sell one option and buy one further out in time with the same strike. A diagonal puts a little twist into it because we're buying or selling an option with a different strike. So you're still using the calendar, you're still using the time with two different expirations. However, you're using different strikes. Reason to do a diagonal spread, twofold, okay? One, you can take advantage of massive disparities in implied volatility, which is I'm going to show you right now. You maximize reward, minimize risk. That is the key to every trade that I make, every signal that I send out, maximizing your reward while minimizing your risk, okay? Why does volatility matter? How do you take advantage of both direction and volatility? So let's take a look here. Here's a real example, guys. I'm going to show you why we did this and what the result was, okay? Here's the NXPI trade that I just talked about. NXPI had earnings last week, okay? As you can see here, if you look on this chart, you can see a bunch of higher highs, higher lows. And also this red line here, guys, this red line, that is the 50-day moving average. Okay, lots of indicators people use out there: moving averages, volume, Fibonacci levels. Okay, lots of indicators. If I look at this 50-day moving average and this time frame of basically over the last 5 months or so, you can see that every time the stock hit the 50-day moving average to the downside, even back here in October where it dropped just below it for a second here, it popped right back up. That held as some very massive support for this stock. Okay, again, you also see this pattern of higher lows and higher highs. So going into earnings, the stock was trading right down here, right where this arrow is, this entry price. Okay, how do you calculate? This is a question for everybody. How do you calculate what strikes are the optimal ones to use? Without just saying, okay, here NXP was about 127 going into earnings. Okay, as you can see here. Why would I choose certain strikes? Why would you choose certain strikes? What would make you guys choose the 135, the 140, the 120 if you were using puts? What would make you choose that? Okay, not a hunch. I mean, you can trade on hunches. I don't trade on hunches. Anyone? Okay, somebody, there we go. Kathy, you just said, what is the expected move, right? So you can figure out by looking at the market pricing of calls and puts, or you can do it real easily on Thinkorswim and some of the other platforms as well. It tells you what the market's expected move is over a certain period of time, what the market is pricing in. Well, in NXPI, the expected move was about $8 going into earnings. Okay, $8. Well, $8 to the upside gives me a target of 135-ish, 136, right in that area. Okay, and obviously, as you can see from the chart here, I was bullish. So I've now combined, I want to be bullish. I've got the expected move, so that's the range that I'm looking for the stock to move. What do I do? Well, here's the volatility part, guys. This is a chart right here. Can everybody see this volatility chart? This is implied vol in NXPI. It's really no different from looking at a stock chart, right? You look at support, you look at resistance areas. Can everybody see this? Awesome. Okay, when it gets up to these levels of high 30s and 40, I want to sell it. That means I'm able to collect more premium. When it gets down to the low 30s or just below, I want to buy it. That means it's cheap. Well, going into earnings here, it was pretty expensive. I want to sell some premium there, especially that front month premium that's going to get so affected by the earnings trade. Here's exactly what we do. Okay, this is exactly the trade. Upside trade. Okay, we traded this diagonal. We did that again, not only to take advantage of the big difference in implied volatility, okay, which you can see here, this IV rank here, this IV area is the difference between the weekly February 7th option that we sold and the weekly February 14th option that we bought. We sold the 136 strike, we bought the 135 strike, okay? So again, calendar, because we're doing this over time, but we're buying a lower strike call here. So it gives us a little bit of extra delta, a little bit of extra movement to the upside. Okay, this is the exact setup. And at the bottom of the screen here, guys, you can see my exact trade fills. Okay, total transparency here, total transparency. So we traded this diagonal. Here's the signal that goes out to our students. It's all time stamped. It's all time stamped. So on the 3rd, we sent this out at 9:30 in the morning to buy this spread for 55 cents or less. selling a very, very expensive option and buying one that's cheaper against it. So really arbitraging the volatility. This is the exact instruction that our students get. Tells you where to buy the spread, when the spread is valid, right? Because we don't want to leave orders out there. What if the stock moves, a ton? We don't want to leave that out there. So we tell you exactly when, where, and how to buy this spread. And then we also, put in here also an XPI reports earnings after the close of the market. So we know that there's a little bit of additional risk in there. Here's the exit, guys. Next day, right on the opening of the market, you can see 8:34 in the morning. Okay, 8:34 in the morning. Exit this thing that we bought for 55 cents for $1.15 or more. Now, why did that work? It's obvious, but why did this work, everybody? Yeah, okay. Stock went up. Yep, that's one reason. Yep, stock went up, and we took a major advantage of volatility. Because remember what I said, guys. What did I say about volatility? One of the first things. It's mean reverting, right? It means the really expensive vol gets cheaper 100% of the time. The really cheap vol gets more expensive 100% of the time. It meets in the middle. We were able to take advantage here of the directional move, which was the diagonal part of the spread. We were also able to take advantage of this huge disparity in implied volatility. 127% profit in 2 days. You know what might be the best part about this, though, guys? Obviously, we gained, it is a great trade. We made a lot of money. But this and every other trade we make, whether it's a debit spread like this or a credit spread, which we're going to get into also, which I know a lot of you liked, said that you like to sell options. Every trade we make is completely 100% risk defined. We go into every trade knowing exactly what our maximum risk is. No unending exposure. We would never do that. You always know the max you can risk. And then every trade we make is based on what is the reward to risk. What is the reward to risk? Because every trade you make, no matter how safe it is, has risk to it. Okay. All right. Again, here's my trade log. You can see exactly what I did here. So you can see my signal was to buy this thing at 55 cents. We actually bought it at 52. The exit was to sell it at 115. We actually sold it at 122. Now, I also said we trade this along with you guys, right? Everybody remember that? We trade these after our students do. Our signals go out via email, via chat, via push notification, and our trades go in after our students get into the trade. If we did it beforehand and say, hey guys, this is what we did, we think you should do the same thing, besides being completely illegal, and that's something called front running, it would be highly unethical. Okay, great question here. How long do you wait to determine a position has stopped going higher? You know what, guys? When you're trading, you have to be able to separate. Are you a trader or an investor? Okay, I'm a trader. If I traded my investments, I'd be broke. That's why I let my financial planner handle my IRAs, my long-term stuff. I would be broke because my mindset is I'm thinking about what's happening in the market in the next minute, the next hour, right? So you have to have the mindset here to be a trader. And you know what I want to do? I want to book my profits, put them in the bank, and use them for the next trade. Okay? All right, next one. Again, has to do with volatility, but it's a very basic trade here. This was just in ULTA, a very simple vertical spread. Okay, vertical spread on the call side, so it's a bull call spread. Okay, definitely a directional trade. However, the reason I was able to get into this next example here, and I'm going to show you so effectively, is because volatility levels were very low. Okay, so this debit spread. So here again, guys, check this out. Everybody see the ULTA chart that's on the screen here? Can everybody see that? Awesome. Okay, look at the white arrows. Those white arrows, which are right around the 270 area that I'm pointing out, okay, so over the last 6 months here, those point to very significant points of resistance. Okay, so each time back in September and then back in December, stock got up there, it failed. It failed. Stock dropped off, failed, got back up here, stock dropped off. And then you know what? The next time that it rallied up, which was in early January, and it rallied above that, okay? That's one of those indicators here. Well, you look to that, and once it broke through that resistance area, if it trades back down to that same area, and in this area here, right around 270, that now technically becomes support. Okay? As you can see here, after it broke through in January 13th, it traded right back down to that area there. Okay? Right back down to that area. I want to get in. That's a bullish indicator to me that it held as support there. So again, though, how do we determine which are the appropriate strikes to trade? Well, that's all based on the market's expectation of a move to a certain period of time, which is known as the expected move. Okay, and in this case here, when we put this trade on, the expected move to February expiration for our trade was about 16 bucks in ULTA. Stock was trading 270 at the time. Puts us right up to about that 285 area. Does everybody see that? Yep. Okay. So at 285, that is our target. So we chose to buy this 285 call spread. It's a bull call spread because of the expected move and because of the fantastic reward to risk. Okay. So what did we do? Here is the exact signal. Here is the exact signal. Same thing. We put that out there to all of our students. Exact instructions. And we wanted to buy this spread for $1.35. Okay, which is what we did. Here is the exit signal. Okay, but in this one, guys, this is how we manage our signals. This is how we manage. We wanted to take off half of our profits. ULTA was in a very bullish pattern. Okay, very bullish pattern. So we wanted to take off half of our profits and manage the rest. So we sent a signal out. Take off half at 210 or more. We got in for $1.35. And then a couple days later, as ULTA continued to rally, we put out an exit signal for the balance. Okay. Does everybody hear a little feedback right now? I want to make sure you can hear me clearly. Yeah? Okay. Well, I'm gonna try and speak over that. All right. So here's the exit. And you can see here is my exact trade log, where we got in, where we got out. The bottom line on this vertical call spread, we were able to buy this cheaply because volatility was very inexpensive. Very inexpensive. That made the premium cheaper. 74% profit in a week. We took advantage of volatility and direction. Okay, calendar spread. Who trades calendar spreads? Who likes to trade calendar spreads? Anybody like to trade calendar spreads? I love them. I'll trade them all day long when I have the opportunity to. Basically, a calendar spread is financing the purchase of an option by selling a different one with the same strike. But you can take advantage of huge disparities in implied volatility and the passage of time to collect some premium. Same kind of setup here in this ACN trade that we just did.
And there's food on there.
Okay, same kind of setup. You can see back here in August or so, got this high around 205, hit up there again, and then it broke through. That was our indicator. That was our indicator to get long here. So what did we do? Right at our entry price here, we got in, we calculated the expected move. Okay, we calculated the expected move to give us which strikes would be optimal and which strategy would be optimal. So we bought a calendar call spread. Now, here's the volatility we sold. Volatility was trading in the, close to the mid 20s here in ACN, which for ACN was very expensive. And you can see what happened right after the trade. That volatility absolutely got hammered. That was one of the big reasons why this thing was successful. Here's the exact signal. Buy this calendar call spread, just a 1 week calendar call spread for 30 cents or less. All the instructions. The next day, we sent the signal out, 45 cents or greater. Okay, now you'll see what the actual fills were. Okay, but the reason this worked, major arbitrage, major difference in volatility between the two options. We used that technical analysis to look for that upside trade, maximize reward, minimize risk. We actually got in, our students got in for 25 cents, sold it for 45 cents 2 days later. 80% profit. Here's the actual trade, guys. Here are my fills. You can see them right here. Again, we trade these along with you. Okay. Any question on a calendar spread? Because now all these three examples have all been debit spreads. And I know a bunch of you said you like to trade credit spreads. So I want to show you a credit spread. And before I do that, what types of credit spreads do you guys like to trade? Because there are all different kinds of credit spreads. I'm typing this in here. All right. There's all kinds of credit spreads. Well, here's what we did. Who knows what an iron condor is? Anybody trade iron condor? Man, can't even speak. Iron condors? Okay, an iron condor, again, remember I said options sound like they can be confusing, but they're really not when you break them down. An iron condor is all you're doing is combining selling a call spread and selling a put spread together. And you do that for a couple reasons. First off, you do it when volatility is really expensive because you want to capture more premium. Okay, so you take advantage of increased volatility to collect that additional premium. You're selling both a put spread and a call spread. But what is the outcome? What do you want to happen when you sell an iron condor? Anybody? Okay, good. Think about it. If you're selling a put spread to the downside, selling a call spread to the upside, you want the stock to stay in the middle of the range, right? You want it to stay. So look at in RH, here's where we did this. Again, here's our volatility graph, guys. You can see it is at absolutely at the upper end. We sold the volatility up here. We bought it almost instantaneously after earnings when it dropped down here. Here is the exact signal, guys. Here is the exact signal. Sell both the put spread and the call spread. Collect a massive amount of credit. Here is the exit. Sold this thing for $3.75, bought it back for $1.10. Okay, now, why is this, even with the sale, a credit spread here? Why is it still risk defined? We would never trade something that is not risk defined. Why is it still risk defined, folks? It's because we're trading spreads. Exactly. Exactly. Jenna, I hope I'm pronouncing that right. Exactly. We're trading spreads. We're always locking in the maximum that we could lose. Okay. So in this instance, we're selling a $7.50 call spread and a $7.50 put spread. Okay, both sides, we collected $3.75 for that. The most we could ever lose is actually that, $3.75. But we chose those strikes again because of the expected move, guys. The expected move that the options price in is so important. It is so imperative. Does anybody know why? Again, I hope I'm not teaching too much here. I'm going to give you a little extra here. When we calculate the expected move, do you know what the market is pricing in the probability of that expected move? Does anybody know? Okay, the expected move is calculated with a 1 standard deviation probability. 1 standard deviation is something that happens 67% of the time. So if I can calculate what the market is pricing in with a 67% probability, okay, I want those odds in my favor. Now, you get moves outside of that, absolutely you do. But over time, if you can price things with that probability and trade your debits and your credits off of that, you're going to do really well. Here is the trade review for this iron condor credit spread. We took advantage of that excess premium because of the increased volatility. Okay, maximized our reward while minimizing our risk. Implied vol was trading at its high point. You can see here we sold this spread for $3.70 and bought it back for $1.15 overnight. Overnight. These opportunities obviously don't come across all day long, all the time. We have to search for them, right? We have to. We have to. It's not easy to find these opportunities. However, they are out there. And when you know what to look for and you can take advantage of that volatility, your P&L is really going to start on the uptick. When you can trade not only direction, but combine that with volatility and understanding implied volatility, folks, man, oh man, it is going to change your trading world. It really is. And as a review here, here is exactly what we did in RH. Here's my trade log. So you can see that again, we do that after our students get the signals. After our students get the signals. Okay, so wins on wins on wins. Are there losses? There are absolutely losses. Okay, fortunately, we don't have as many losses as we do wins. Okay, and you'll see here in a moment, our win-loss rate for the last year is near 65%. Okay, the key is on our losses, we always know what the maximum loss could possibly be. We are completely risk defined. Okay, now we don't send out 20 signals a day. We don't, trade 10 different signals a day. This is about quality, guys. It's not about quantity. Okay, in the last year, okay, we've had over 80 winning trade signals that we have sent out to our students. Okay, all of you know that there is no way that you're going to win 100% of the time. In fact, anybody that tells you they win 90% of the time, run. Okay, you have to factor in the probability of a trade with the reward to risk. And everything that we do is based on reward to risk. All right. I want to take some questions here. Are you guys ready for double and triple digit gains? Because I'm ready to show you what we do here. So this is the Prosper Trading Academy Profit Alerts. Okay. The fastest way to profits is to follow a real trader. That's me. That's me. A trusted, proven trading expert, not afraid to share my portfolio with you guys. You get premium floor speed signals. You get them sent to your phone, sent to your iPad, sent to your mobile device in real time. You get them via email. Okay? You get them right away, again, before I ever trade anything. Leverage winning trade signals. You get the trade, place the trade, and as you saw, there are instructions so you can understand every trade you make, why you're making it. There's reviews. We want you to be successful, and in hindsight, afterwards, know why you were successful or why a trade didn't work. Okay, so this is what you get. The floor speed trade alerts, video updates from me, because when I put these trades out there, when I discuss them with my class, I'm recording these because I want our students to be able to review exactly why we did something. Okay, we have a volatility indicator that we use. It's actually based off Thinkorswim, but you can use it on any platform that alerts us when a particular stock has volatility or premium that we want to sell at our levels, or when we want to buy it at our levels. Okay, and our trade tracker in our room that shows everything that's on our watch list and all of the trades we've made. 100% full transparency. Okay, as you can see, the total package value, yeah, whatever, $7 grand-ish. Today, we are offering this to the first 25 people that are here for $497. $497. However, this honest to God is limited to the first 25 people. I wanted it to be more. Jeanette said no chance. No chance. Okay, so the first 25 people will get all of what you saw here, our alerts, the indicators, the video updates, the trade tracker, all of this 3-month access for $497. Okay, thank you, Jeanette. I think you just posted up the link up there in the chat room so everybody could see that. Okay, we're going to go back to that here, but again, just go ahead and Google me, Google Prosper. Look for, reviews out there, guys. These are actual reviews, and not only that, you can see me every single day on TV. You can put the name with the face. You can see the legitimacy. of what I do. I'm out there on TV every single day putting my neck out, not afraid to talk about what we're doing in our class, the trades we take, so on and so forth. Okay, you'll be able to see all these comments here. Okay, you'll be able to see all these comments. Okay, I mentioned earlier, almost 65% win-loss since the beginning of 2019, 64% win-loss ratio. Lots of losers, guys, lots of losers. Fortunately, almost twice as many winners. Okay, as I've said, and this is so important regardless of what service you use, guys, this is key. This is key. No front running. You will 100% have the trade before I make the trade. To get signals after the fact, no good. No good, guys. This is so important. However, and wherever and whatever you are evaluating, make sure, okay, make sure you are looking at that, and that when you get a signal from somewhere else, if you're getting them, make sure they haven't already traded it. All right, Q&A time, guys. I'm going to put this back up here. It's Q&A time. Okay, we've got, what, about 10 minutes left here. Anything is on the table here. You want me to talk about a particular stock? I'll talk about a particular stock. You want me to talk about one of these strategies? Let's have it. Okay, here's one from Christine. Christine says, how do I know what volatility is high and what volatility is low? Well, it's real easy to look at an implied volatility chart, and depending on the type or whichever platform you're using, Thinkorswim or E-Trade, Fidelity, whatever it is, they all have some sort of chart there. Okay, so in its most basic form, you look at an implied volatility chart much like you would look at a stock chart, and look for those support and look for those resistance points, okay, for implied volatility. And again, know that implied volatility of an option is mean reverting, MEAN reverting, meaning it always comes back to the center 100% of the time. So when I can combine a strategy directionally with also taking advantage of volatility, that's the holy grail to me, folks. Okay, okay, great, George. What actually is implied volatility? That's a great question. Implied volatility is the market's measurement, market's prediction of what may happen to a stock in the future based on what's happened in the past. So the options then are priced accordingly. Okay, and I don't want to get too scientific or too detailed here, but everybody probably knows that there's an options pricing model. The option pricing model is based off of something that was created back in the 70s called the Black-Scholes pricing model. Okay, this is what I tell all my students. You do not, absolutely 100% do not have to know what the Black-Scholes pricing model is. What you have to know, though, is what goes into the model to get my output. Okay, that's what you need to understand. It's kind of like if you make a smoothie. Get up in the morning, you want to make a smoothie for breakfast. You have your ingredients. You have your banana, strawberry, yogurt, whatever it is. You put it into the blender. You have no idea what happens when it's in the blender, right? But then you get your outcome. Same thing with the option pricing model. And one of the biggest things to understand about options and the model is how volatility affects the price of those options. Okay, volatility is king. Volatility is imperative to increase your profitability. Okay, how do I know when to take losing trades or when to stop myself out on losing trades? Here's kind of my goal, guys. Okay, and this is just something, again, after doing this for almost 30 years, trading real time on the trading floor at both the CBOE and the CME, and then trading on the screens like we're all doing here. My strategies that I have come up with over time, okay, I typically look for anywhere between 70 to 100% profit on the winners. Sometimes we let it go more, okay? And on the losers, look to cut them off at about 50%. Okay, that's what works for me. That's what works for these strategies. I am a very, very risk-averse trader. I always have been. When I was on the floor of the CBOE, I was known as one of the largest traders on the floor, but that didn't mean I took excessive risk. I was always risk-defined. Okay? How long will it take me to learn to trade volatility? Well, this is like learning a foreign language, right? Trading in general is like learning a foreign language. It's a marathon. It's not a sprint. But the more time you take studying it, it will become second nature. It absolutely will become second nature. Okay, but remember, there's no quick fix here, guys. There's no, there's no get rich quick scheme. That is not what my program is about. That's not how I trade. I want to be the best bunter on my team. And I'm a baseball guy. Sorry, guys, if I exclude you here. I'm a huge Cubs fan, born and raised here. But I'm a big baseball guy. So I like to put things in baseball perspective. I want to be the best bunter on the team, meaning I want to grind my profits out. I'm not swinging for the fences. If I get that 100%, that 150%er, awesome. But I'm grinding it out, maximizing those profits, but more importantly, absolutely minimizing my risk. Okay, I think we got time for just a couple more questions here. Okay, someone's asking about these trade alerts. Okay, and how you get them. Once you sign up, guys, you will have an app on your phone, or you'll not an app, but you will get these push notifications directed to your phone, your iPad, your mobile device, whatever it is, in real time. In real time. You get it on your phone via push and also via email. They go out in real time. And not only, obviously, the entries, the exits, or any other sort of management as well. Okay. The video updates, someone's asking about the video updates. Yep, same thing. We will send them to your inbox. They're also available on demand. They're also available on what we house as our campus, our video campus, so people can access them all the time. All right. Jeanette, I'm gonna get in front of you here and ask the question, because I know you're gonna ask it in a minute here. How was this, guys? And don't be afraid to criticize. If you liked it, let me know also.
Hey, that's
but how was
fair.
this?
To wait for me to ask that when you're gone.
No way.
Cheating, you bunter. What are you doing?
Full transparency, right? Full transparency. Right. You can ask it now.
If your questions didn't get answered, retype them, because there's just so many questions flowing in that he may have missed it. So if you haven't gotten your question answered, if you could just retype it, Scott will answer it right now. We have about 7 minutes.
Okay, here's one. What do you do when the trade goes against you? You showed us all these winners. What do you do when the trade goes against you? You try and manage it. Okay, sometimes you can't manage it. Sometimes with these volatility trades that are based around earnings, that are so affected by a binary event, right? Like an earnings release, sometimes you don't have time to manage the trade. However, going into the trade, you know what that max exposure is. It's never more than that. Do we absolutely have trades that don't work where we hit that max exposure? We do, 100%, 100%. Okay. However, we absolutely manage our trades along the way. As you can see, remember in ULTA, remember the ULTA trade, guys? We were in the middle of this volatile environment, the market trading in 1,000-point ranges over the last 2 weeks, up, down. And so what did we do in ULTA? We took some profits off the table on half our position just to have a little cushion, and then let the other half run. Okay, so we are on top of what we do. We don't just send the signal and then let it stew, let it work. We are constantly helping you manage and guiding you to what these signals are. Okay, next question. Why did you trade a diagonal in an XPI instead of a calendar? Great question. Every trade that I make comes down to the reward to risk. Okay, obviously the more risk you're going to take on a trade, guys, the more reward you have to be paid. The less risk, the less reward you should be paid. I have built over, my almost 30 years of doing this, I have guidelines of reward to risk levels that I want to see dependent upon the trade. Calendar spread gets X, diagonal spread gets X, iron condor gets X, butterfly gets X. And those reward to risk ratios have to come into play. And so I look for, okay, here's the risk I'm taking, what's my reward? And basically it's connecting the dots, guys, to look for the strategy, look for the setup that has the best reward for that risk I'm taking. So that's why in that instance, I chose to take the diagonal instead of the calendar, because the reward to risk metric was better. Okay. Okay, why did you have 3 examples of debit spreads and 1 example of a credit spread? Honestly, those are just the examples. Okay, those are just the examples that we showed out here. Again, I forget who it was, maybe Natalie, someone earlier, when I asked, which is the better way to trade, credit or debit spreads? I trade them based on what the market is telling me in terms of volatility. When premiums are expensive, I'm selling credit spreads. When premiums are cheaper, I'm buying debit spreads. Okay, here's one. Not sure I totally understand this one, but how much will the loser lose? Will it be as much as my small gains? Okay. Well, again, I'm looking for 70 to 100%, if not more, gains on my trades, and typically out at a 50% loss. So the gain, not only that 64% win ratio on trades, winning trade versus losing trade, not only is that almost 2 to 1, but the percent profitability on the trades as well are almost 2 to 1. So hopefully that answers that question. Okay. What was it like being a Goldman Sachs trader? That's a loaded question. Actually, it was fine. I mean, when I was running the S&P 500 operation for Goldman Sachs, it was probably the most hectic time ever in the financial markets, at least in our time, because it was during the financial crisis. I was in the S&P 500 pit when the famed Mark Haynes bottom. Mark Haynes used to be the anchor on CNBC when the S&P's traded 666. Okay, so right in the midst of financial crisis, down at the very, very bottom that this market hit back in the late 2000s. So it was hectic, it was intense, it was captivating all at once. And I learned so much more about volatility trading during that time as well, and how to leverage volatility. All right, folks, I really, really, really appreciate all of your time. It's a Saturday morning. I know here in Chicago, it is just another dreary day. We're supposed to get some snow later, so I don't know what I'm going to do the rest of the day now, but I hope you guys all enjoy the rest of your weekends. Enjoy the next 2 presentations. Okay, Jeanette, thank you for the opportunity. What you guys do is so important for your clients and people out there that are, looking to get into the market. So thanks for having me as part of your day. And I wish you guys a great weekend. Thanks
Thank you,
again,
Scott.
Chad.